Somewhere this week, a silver investor opened their trading app, saw the price sitting well below where it was just a few months ago, and felt that familiar knot in their stomach. Should they sell before it drops further? Should they buy because it looks cheap? Or should they do nothing at all and just watch? That single moment of hesitation is playing out in thousands of households across the country right now, because silver has just lost the kind of momentum that used to make this market feel unstoppable. But here's what most investors never realize. The real story isn't just about the price falling. It's about one specific indicator, quietly shifting underneath the surface, that could end up telling us more about where silver goes next than any headline ever will. If you're new here, welcome to a channel built for people who want to actually understand their money, not just react to it. Before we go further, if this kind of grounded, no-hype market breakdown is useful to you, take a second to like this video and subscribe to Smart OG John Ag. It genuinely helps more people find thoughtful financial education instead of noise, and it costs you nothing but a click. Now let's talk about what's actually happened. Silver spent last year on one of the most remarkable runs in recent memory, climbing dramatically as investors piled in, industrial demand stayed strong, and the US dollar weakened. Prices pushed to levels many long-time silver holders never expected to see in their lifetime. Then, almost as quickly as it rose, the market pulled back hard. Silver has been trading in a fairly tight range recently, well off its highs, and for a lot of investors, that kind of reversal feels personal. If you bought near the top, you're probably feeling some regret right now. If you've been waiting on the sidelines, you might be wondering if this pullback is your window. Here's the part that changes everything. Price alone doesn't tell you what's really happening inside a market. Two people can look at the exact same chart and walk away with completely different conclusions, because the price is really just the visible tip of a much bigger, much quieter process happening underneath. Let's talk about why silver may have cooled off in the first place. A big piece of it comes down to the US dollar and interest rate expectations. When the dollar strengthens, and when investors believe the Federal Reserve is more likely to keep interest rates higher for longer, precious metals like silver often become less attractive. That's because silver doesn't pay you any interest or dividends just for holding it. So when safer, interest-bearing assets start offering more attractive returns, some money naturally rotates away from metals and into things like bonds or cash equivalents. Comments from Federal Reserve officials about inflation and policy direction have been moving markets almost in real time lately, and silver has been especially sensitive to every word. But here's another reason the market may be reacting this way, and it rarely makes the headlines. Silver isn't just a financial asset. It's also an industrial metal. It's used in solar panels, electronics, medical devices, and a growing list of technologies tied to renewable energy and even artificial intelligence infrastructure. That dual identity is part of what makes silver so unpredictable. When investors are worried about the economy slowing down, industrial demand expectations can soften, and that adds another layer of pressure on top of whatever is happening with interest rates and the dollar. Most headlines focus on one story, usually the Fed, while the real signal may be somewhere else entirely, quietly building in the background. Now let's get into the indicator that a lot of casual investors overlook completely. It's called relative strength, and in simple terms, it's a way of measuring how fast and how far a price has moved recently to figure out if a market is stretched too far in one direction. Think of it like a rubber band. When a price rises too quickly, that rubber band gets pulled tight, and eventually it tends to snap back, at least temporarily. When a market falls sharply and then starts to stabilize, that same rubber band can start loosening in the other direction, sometimes signaling that selling pressure is easing even if prices haven't turned higher yet. Right now, that kind of momentum reading on silver has been sitting in what technical analysts often describe as weak or bearish territory. But there are signs it may be gradually turning higher. That doesn't mean a rally is guaranteed. It simply means the intensity of the selling appears to be fading, which historically has sometimes preceded a period of stabilization or a bounce. This is where things become really interesting, because markets rarely move in straight lines. They tend to overshoot in both directions, then work their way back towards some kind of equilibrium. Let's bring this back to something real. Picture a retiree who bought silver years ago as a way to protect their savings from inflation. They're not trading daily, they're not glued to their screen, but when they see a sharp pullback like this one, it's natural to feel uneasy, even scared. Here's what's worth remembering. Long-term investors who buy physical metals or metal-backed ETFs for wealth preservation are usually not trying to time every short-term swing. They're trying to protect purchasing power over years and decades. A few months of consolidation, even a sharp one, has historically been a fairly normal part of that longer journey, not necessarily a sign that the original reasoning has broken down. Now compare that to someone checking silver prices on their phone before work, someone who bought recently, closer to the highs. That person's experience feels very different, even though they're looking at the exact same market. This is part of why understanding your own time horizon matters so much. The market often rewards those who understand this difference between a short-term trader's reality and a long-term investor's reality, because reacting emotionally to normal volatility is one of the most common ways people damage their own returns. There's another layer worth understanding here, and it involves resistance levels. In simple terms, resistance is a price zone where a market has previously struggled to push through, almost like an invisible ceiling built from past trading activity. Right now, several of those ceiling levels sit meaningfully above current prices, based on longer-term moving averages that many professional traders watch closely. A moving average is just the average price over a certain number of days, used to smooth out the noise and show the broader trend. When price is trading well below its longer-term averages, that can suggest the broader trend has weakened, even during short-term bounces. Many analysts believe that a decisive move back above those levels would be needed to meaningfully shift the broader trend back toward strength, while a break below the recent lows could signal renewed weakness instead. What happens next may surprise you, mainly because nobody actually knows for certain, including professional analysts. What we can say, based on historical patterns, is that sharp corrections after extended rallies are extremely common across almost every asset class, not just silver. Research on market behavior generally suggests that assets which rise very quickly often need a period of consolidation or pullback to work off excess speculation before any sustainable next move can develop. That doesn't guarantee silver will resume climbing. It simply means that what's happening right now isn't unusual by historical standards. Later in this video, we already covered that overlooked momentum signal, but here's one more piece many investors miss. Gold and silver tend to move together over time, but silver is historically more volatile in both directions, meaning it often falls harder during pullbacks and can also rise faster during rallies. That relationship, sometimes tracked through what's called the gold-to-silver ratio, gives some investors a sense of whether silver looks historically cheap or expensive compared to gold. When that ratio sits at elevated levels, some market participants view it as a signal that silver could be undervalued relative to gold, though this is an observation about historical patterns, not a prediction of what will happen next. So what does all of this actually mean for you as an investor? A few practical habits tend to separate calmer, more successful investors from those who struggle. First, understand your own timeline. A short-term trader and a 20-year holder should not be making decisions based on the same daily headlines. Second, avoid making large decisions purely out of fear or excitement. Emotional decisions made during sharp price swings are historically some of the most regretted trades investors make. Third, pay attention to indicators like momentum and moving averages, not because they predict the future perfectly, but because they help you understand whether a market is stretched, stabilizing, or trending, which adds useful context to whatever the headlines are saying. And finally, remember that diversification exists for a reason. Precious metals can play a role in a portfolio focused on wealth preservation, but they're rarely meant to be the entire strategy. If current conditions continue, with interest rate expectations shifting based on incoming economic data, silver may remain sensitive to every Federal Reserve comment and every employment report for the foreseeable future. That kind of sensitivity can create real opportunity for patient, informed investors, but it can also punish anyone trading purely on emotion. Before we wrap up, I'm curious what you think. Do you believe this recent silver pullback is a healthy reset within a longer uptrend, or a sign that the bigger rally may be running out of steam? If you already own gold or silver, how are you personally approaching this current stretch of volatility? Drop your thoughts in the comments, because these conversations genuinely help other viewers think through their own approach with a bit more clarity. If you found this breakdown useful, consider sharing it with a friend or family member who's also trying to make sense of gold, silver, or the broader economy right now. Thoughtful financial education tends to spread best when real people pass it along to people they trust. Markets like this test patience more than intelligence. Silver may have lost some of its momentum for now, but understanding why prices move, rather than just reacting to headlines, is what tends to separate long-term success from long-term regret. Keep learning, stay patient through the uncertainty, and always remember that every investment decision should ultimately be based on your own research, your own risk tolerance, and your own financial goals. Thanks for spending this time with Smart OG John Ag, and I'll see you in the next one.